All righty, folks, it's time to talk about the Fed. Is the Fed put in a box? We've got tariffs, even though they are reduced, still averaging 13%. We have the consumer sentiment numbers, which on Friday were freaking ugly, the second lowest reading in the last 50 years, other than the pandemic, the worst ever. We have clearly demand destruction, levels of uncertainty in an economy that I've never seen before. We've got slow growth, the threat of higher inflation. I don't know about you, Taylor, but the Fed is in a really, really tough spot. What say you?
I think I'm going to cry after that intro. Yeah, I would say the Fed's in a tough spot. It's interesting. We've had, the forecast for futures on interest rates move dramatically lower, where at one point there was 4 cuts baked in this year. Now we're down to like 1.5 cuts baked in for this year. And Raphael Bostic this morning, Fed chairman out of Atlanta, said, uno, you will get.
Yeah. We're getting really close to zero, man. I called zero a long time ago. It's certainly going my direction.
We are. And I've been on the other side of that. I don't know that my comments have been forecast, but I have said that we need to get a little bit further ahead in this rate cut game. But yeah, it's an interesting paradigm that we're in right now, because the Fed is going to wait until they can see the whites of the eyes, right? Mm-hmm. Mr. Too Late, as Trump calls Jerome Powell. He has shown that is the case. Like on the onset of raising rates back in 2022, he was too late. And now he is waiting until we see very, very clearly that inflationary issues have abated. And the issue with that is the vast uncertainty that the administration has put into the system right now. We just don't know exactly how it's going to shake out.
Yeah. And in my intro, I even forgot, another kind of wild card was President Trump's, bashing of the Fed president, right? Mr. Too Late. Like when I look at this, trying to be an observer from, I don't know, 10 or 30,000 feet, whatever you want. And I try to look at the U.S. economy, which I've done every day for 30 plus years. When in doubt, I focus on the consumer, right? It's the largest engine of the economy, 64, 65, whatever, right? The biggest part. And I have honestly never seen a time where the consumer has been this uncertain, right? That includes the .com crash, 9/11, the 80s. It's just the fact that it's more uncertain today during the pandemic should tell you everything you need to know about what's going on with the consumer. And as I've learned for 30 years, when the consumer is uncertain, Taylor, they sit on their ass and do nothing.
Yeah. Yeah. And I think the one that's the headline that has all the uncertainty stirred up is tariff. And then last week, Friday afternoon, all of a sudden, whack, you get hit with budgets. And you're like, okay, well, we had this administration come in and say we were going to start to decrease our budget deficit. But Moody's is looking at the spending bill going forward and saying, what are you talking about? You're actually going to blow out this budget deficit further from where it has been. And that comes on the heels of Obama, Trump, Biden, now Trump again, all saying, okay, we'll work on budgets. And then they just inflate them further and further.
Yeah, this just not a good place to be. So when we step back and look at the Fed, arguably, the most famous thing they're known for is having a dual mandate, right? Stable prices and full employment. When you look at them today, and again, we'll be very specific, it's May 19th, 8:33 a.m. Pacific. I think based on all the Fed talk I have heard, and I look for it every morning, right now it seems overwhelmingly focused on pricing. That is the big bugaboo. Tariffs, as all of them, or at least most of them have said, were bigger than expected, faster than expected. We've seen inflation expectations of consumers blow out now 5%. I mean, wild numbers. Do you think that's accurate? Do you think that the Fed, as of this morning, the thing they're most concerned about is inflation and stable prices?
Yes. And what's interesting is I would have told you that 6 months ago-ish, when we saw a little uptick in inflation, in unemployment. Unemployment was actually the focal point, was, okay, where actually full employment, is this actually starting to see a tick up? Because we know that historically you get a tick up, and then either it abates or it snaps. And I think the real fear was that we were going to see a snap higher in unemployment. And that's why the Fed got dovish. and cut rates. And some people would say, and I think that there was potentially an argument to be made here that was also politically induced.
Oh, there's no question. There's
Yep.
no question that it was at least somewhat politically motivated. I mean, you have a former Fed president basically saying the Fed should have done all they could do not to get Trump elected. I mean, that's pretty black and white to me.
Totally.
That was put out there. So, but when I step back and look at it again today, I ask myself the next following question. I think we both agree that today they're focused on inflation.
Agreed.
The thing that I worry about, or I look at next in the set of dominoes, is how hard, to your earlier point about it taking the elevator up, does the job market have to break for that to go in front of inflation? Right. And let's try to put some numbers on it. I think the last reading we had for unemployment was 4.2%. So I actually ask myself, do they care about 4.3, 4.4, 4.5? Like, what is this? Is it not a number? Is it a rate of change? Because that's what I'm focused on next, is how or if does the job market suddenly become priority one? Because as long as inflation is priority number one, they are not fucking cutting. It is not happening.
Correct.
So I ask myself, how does that happen?
I think you hit the nail on the head. I think it's the rate of change, right? And I think, well, I say that, but it's also the level, because if you get a tick up, again, we've seen historically where the rate of change changes direction very quickly, where all of a sudden it goes tick, 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 bang.
Bam.
That.
Yeah.
So I guess rate of change has to get you to that point of fear, but we do need to see it tick up. It hasn't ticked up. They have had no reason to be fearful of the the labor market. We've continued to have historically low unemployment rates. Now they're not as low as the 3.5 or whatever it was a year and a half ago, 2 years ago, when if you flipped from this job to this job, you had all the power in the world. And they were like, okay, here's an extra 50 grand, whatever the number was. But at the end of the day, with unemployment numbers not moving higher, they can kind of afford the ability, until they can't, to be hyper focused on inflation.
Yeah. So again, I want to kind of play this out, because this is really the big question I have for myself. Because again, I think it's fairly clear, as long as inflation is priority number one, they will not cut. That means no cuts all year, as I've said the whole year. But if the job market breaks, and I want to just play this out, you tell me where the line in the sand is. Let's just say, and I'll do this one of two ways. One will be the slow and steady. Let's say over the next, every other month in the jobs reports that come out during the first Friday of the month, usually, we go up a tenth. So we go from 4.2, then to 4.3. Then we skip a month, then 4.4. Then we skip a month, 4.5. So over the course of, I guess that would be 8 months, we'd be at 4.7.
Yep.
Is that enough to jump the job market in front of inflation, in your opinion?
And are we assuming that inflation stays tame between now and then?
Inflation. We're going to assume inflation for this analysis doesn't move an inch. It's just it is what it is.
Yeah. I don't think that speed scares them because that means it's very tame and it's very orderly, I think, is what that tells us.
Yeah. So I agree with that. I think these, like, I'll call that the escalator up, right?
Yep.
Slow and steady up.
If it was, and I'm not sure if this is where you're going with your analysis. If it starts to tick up 1/10 in monthly increments, that begins to scare them.
That was the next point. So if we go from every other month to every month, right, it goes from 4.2 to 4.3 to 4.4 to 4.5 to 4.6, and we're at suddenly in 8 months we're at 5.1. That's a problem.
That's a problem. That's a problem because it won't do that, right? We know it won't do that. It can do that for a few months in a row, but then
it spikes.
Bang.
Yeah.
Or what it did last time around, where it ticked up. I think it was more of your escalator model, where it ticked up, went flat, ticked up, went flat. And the fear was it was going to start to tick, 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 tick. And then it actually rotated back downwards. So it's been, we are in this game of just so much money sloshing around. I mean, monetarily, we were at zero interest rates for 20 years. And then we just pumped money into the economy. And then also, it wasn't just the monetary system where it was incredibly loose from a Fed perspective and got on the brakes too late with raising interest rates, but it was also the fiscal side of the house. Washington, D.C. was just spilling money into the market. So we're at a weird point. And at one point, does it all come to fruition? Does it all come to a head? And that's why I think, and this is kind of reverting back to one of our earlier conversations, what is this little pinprick, right? We have stocks right now. And again, I know that we don't just think about stocks here, but stocks are trading at 22 times earnings. That means they've only been more expensive twice in the last 40 years, during the dot-com bubble and during the 2021 kind of meme stock mayhem of stimmy checks, PPP loans, et cetera. But now we're back to basically that same point. We've got tariffs outstanding. We've got this budget issue. And then Moody's comes in and says, hey, idiots, you guys have a debt problem.
Yeah. Stop spending, you crack addicts.
Can that little thing be a prick? And again, I don't know. And the way the market works is whatever happens, the narrative will justify that. So, it was all Moody's. Moody's did all that. No, we've just gone up for 4 weeks in a row in the stock market on nothing, right? On trade rumors, right? And we did get a delay done with China, and we got a deal done with the UK, which means nothing.
Nothing.
We actually are at a trade surplus to them.
So
wild. It's like, what actually happened to drive the stock market up 20% in a 3-week period of time? Nothing. So now it's back to valuations that are too steep. And does this little pinprick where, guys, your debt issue, think about it as you're working on your budget that are going to come out through the next few months here. And it's got to go May. May is Congress. June is the Senate. And then in July, it's got to go to the president's desk. So we got to make it through both houses. And I meant to say the House, the Senate, and then it's all got to happen now. And that was just a warning shot that, like, guys, you can't just continue to run this bar tab.
Yeah. No, I think, when I look at this, and we're going to close on this topic, because again, I'm legitimately asking myself most mornings, how does the job market jump in front of inflation? Because that's how you get rate cuts. And the thing I'll say here is, folks, you got to be careful what you wish for. Lots of people are asking for rate cuts. The way to get them is ugly. So I ask myself right now, currently the market is saying we're going to get 1 or 2 rate cuts. So I'm just going to say, I then go to myself, so okay, how do we get a cut in October or December? And the only thing I can ask myself is, what does the unemployment rate have to be? Today it's 4.2. So I ask myself questions like, does 4.5 get a rate cut? No chance, right? No chance in September. Does 4.8 get a rate cut? Maybe. Does 5? Absolutely. Yeah. It's kind of how I answer that riddle in my head. How do those 3 numbers feel?
I think they feel right. And at the same time, it's just really hard to take a tariff number and say, take an inflationary number on the other side of the equation and say lower.
Yeah.
It's really hard to do
by
that,
September.
That's another catalyst. Yeah.
It just doesn't feel right. So again, we have disagreed on this much of the year. Would you agree? I think you've agreed all along that 0 rate cuts all year is a non-zero opportunity. I think early in the year it was a small number. Now it's probably bigger.
Yeah. And my comments this year have not necessarily been on, hey, what is the Fed going to do? It's more on what should the Fed do? And I do think the Fed should cut, because I think the unemployment number is going to become an issue before inflation reverts back upwards and becomes an issue again. But, I could be wrong. And that's exactly why the Fed is waiting, because I could be wrong.
Yeah, it is. Talk about a job I would never want. Right now, I mean, is the base case stagflation? I mean, is the Fed actually saying our base case is stagflation? I think they are.
Well, they aren't saying that in that vernacular, but they absolutely
not
are.
Clearly.
They show their dot plots where unemployment goes up, as does inflation. So yeah, they are absolutely saying that. And a year ago, they were saying, I don't see a stag or inflation. And granted, it's gotten worse since then, but I think it was crazy to say. And we laughed at them for saying that back when they said it a year ago.
Like, dude, you're going to regret that.
Totally.
He sure
thought
did.
it was funny. Thought he was funny.
There you go. Taylor, you do amazing stuff in 60 seconds. I still don't know how you do it. Where can people go get it?
Yeah, find us on Instagram and on TikTok at Life Goal Investments.
You're amazing, man. Take care.